address the question of returns and diversification. So recently I got a call asking, hey Adini, what's a good return on my investment? How do I know my money is really working for me? That's number one. Then two, there's always talk about diversification, like how do you really diversify? So I'll start with the diversification aspect. Back in the days, it was a 60-40 stocks, 40% bond, which made sense. But these days I noticed that a lot of people just flood into equities. And in your mind, you think when you buy, say, a lot of stocks, that's diversification. But the answer is that's not. The truth is that's not what diversification means. So basically owning or investing in a lot of stocks heading in the same direction, for example, a lot of tech stocks that have very strong or slightly positive correlation to each other would not be considered diversification. The way I define diversification is having assets that have low to negative or no correlation scattered around your portfolio. So basically you want to invest in assets, for example, bonds and stocks. You'll probably sprinkle some crypto, or even within the stock, you want to have stocks that do not necessarily trend to each other. For example, you want to have some positive beta stocks, some negative beta stocks. If you're long the S&P, maybe some, volatility index in there as well. But yeah, that's what I have to say about diversification. Let's talk about the returns. Inflation is real. It's about 2 to 3% on average year to year. If you are earning anything less than 2 to 3% from year to year, you're losing money on your investment. Because think about it, buying power wise, the same gallon of milk you could buy this year at $1 will probably cost $1.02, $1.03 next year. It just went up 3%. So unless you're making more than 3% on your returns, you're basically flat. And if it's lower than that, it's like a slow cankerworm eating away at your money. And also remember, the S&P does about 8 to 9% on average every year. That's, somewhat the ideal, the benchmark. So even if you're investing by yourself, you should be getting between 8 to 9% at the very minimum, on the S&P, just indexing. Anything below that, it's subpar. You can do this. It's very possible. There are techniques, there are strategies that you can use to be able to generate, above the S&P, or at least a par. For example, if you put your money in the SPY, you'd be a par with the S&P. You're just going to have a lot of volatility going back and forth. But yeah, there are strategies you can use to generate good returns greater than the S&P going forward. Again, my name is Adini Ajoloko. This is my response to the questions that I got this week. I look forward to answering more of your questions. Feel free to reach out to me anytime. Thank you. Have a good day.